Hi, everybody. Kathleen here. Thank you so much for joining our non-farm payrolls markets live. What a week it's been. I know a lot of people are absolutely exhausted by these huge moves that we've seen on the markets. And it is worth noting this is a market live about non-farm payrolls. But will non-farm payrolls be overshadowed by the other things that are going on in the markets? We've had major geopolitical changes in the last week and some economic changes as well. So there's the tariff uncertainty in the US. Who are the US aligning with geopolitically? And then we've also got that boost to defense spending and that fiscal bazooka from Germany to try and boost their economy. Now, we're going to look at the Bloomberg terminal in a moment, and we're going to discuss what's gone on. Here we go. We have it. So I'm just here showing you what are the expectations from Bloomberg around today's data. So we've got, we're going to have some revisions, but they are going to be just small revisions. So we won't worry too much about them unless they're a big number. We've got change in non-farm payrolls expected 160. So the headline figure there for payrolls, 160,000. That is up from the January's number of 143, which, if you remember, was impacted by some weather-related events. Now, there is a chance that weather will have impacted this one as well. Over the last 12 months, this is a good stat, weather has kept more than 400,000 people out of work in the US. The last time that happened was 1977. So the unofficial market number that we're hearing that we've been hearing in the last kind of day or so, this is just a market guess, really, which is separate to the economist estimate, is that it will be weaker than the economist estimate. Now, some of that, some people are looking for more a 130 to 140,000 increase, which would be quite low. It would be lower than January, be one of the lowest levels for the last couple of years anyway, which I think if you take out some extreme cases like the October one, the October reading, and I think that would be seen as a real negative, and it would really cause more concern around the US economy and the strength of the economy. Now, we also have the unemployment rate that's expected to remain steady at 4%, but do watch that. That's knocked sentiment, particularly towards US stocks, when it has ticked up. It hasn't had a massive tick up, and it has been fluctuating around the 4.1, 4.4% area for a while now. We've also got average hourly earnings. That's going to be key as well. The market's expecting a 4.1% annual increase in average hourly earnings, but always watch that because that really is keen to show inflation pressures. Now, there are some, obviously I mentioned about weather could impact this report, but there are also concerns about what Elon Musk is doing with Doge and cutting government spending. Now, economists expect that government jobs grew by 14,000 last month. Now, that is about half the level from January, but the federal government workforce, it's worth remembering, is quite a small number of the overall government jobs. So a lot of the government jobs are actually in local or state level jobs, and they're not captured by the NFP. The Challenger jobs report, which was released earlier on, now that reported that the loss of 62,000 government jobs last month, and that could be another reason why the market is just a little bit bearish about this number going in. Now, just before we start, we've got a few seconds left. I'm going to show you world equities. Take a look at the line that says percentage change. That shows you today's moves. It is a sea of red, as you can see. On a 5-day basis, so over the course of a week, we've had some hefty losses. There have been some real concerns there about what tariffs are going to do to the dynamism of the US economy. And we've seen some real bruising results. I just want to show you another chart here. NVIDIA is now down more than nearly 13% on the year. It fell really sharply yesterday. It's just waiting for this chart to come up. And as you can see, NVIDIA, so that's the AI darling from the last couple of years, is now back at its lowest level since September. So it's really erased all of that Trump bump. Let's just get back to that figure so we don't forget it. Okay, we've got 40 seconds. I'm going to be able to show you what the euro is doing, moving back towards those highs around 108.70. Is the high so far today. So we're going to be looking at that. A weak number could see this shoot higher because the dollar is very much weaker. And then we've got US S&P 500 futures. They are weakening into this report. So I think that's on the back of expectations of a weaker number. Now we've got 15 seconds. All the excitement. What are we going to get? Higher or lower? 160 is the number to watch out for. And the market, is pricing in, certainly acting as if we're going to get a weaker number. And we're going to see in 3, 2, 1, any second now. There we go, 151. So slightly weaker. The unemployment rate has ticked up to 4.1%, and the average hourly earnings has weakened slightly to 4% annual rate. If I just quickly look, oh, sorry guys, at the details of this non-farm payrolls report, I think that's going to be critical. We have seen a downward revision as well, guys, to the January number. So if we just look here, what have we seen? Government actually stronger jobs for February, and we have job losses in leisure and hospitality. We have construction was fairly weak, mining and logging weak as well. Otherwise, we have definitely seen a slowdown. We're seeing a loss of momentum in the labour market data for sure. Now, let's take a quick look at what the market is doing. As you can see, this is the US S&P 500 futures. They're fairly flat, but they are close to the lows of the day. We've got the euro. It's spiked higher, but not by much. Remember, it's been expecting a lot of, it's already been kind of expecting weakness in the US economy. So it's got a lot of that is priced in already. So it does suggest, I think that the momentum is definitely on the upside for euro, on the downside for the dollar on a broad basis. Let's take a quick look at dollar yen as well. Oh, there we go. This is the dollar index here. It's barely moved. That's quite unusual. I'm going to just show you dollar yen. That was just a chart of dollar yen and ISM services, but dollar yen is slightly higher. So it's moving higher. So this is weaker than expected, but it's better than what some had feared it could be. Now, as I said, there's a lot of expectation here about weather could have impacted this report. We could have also seen government jobs. We certainly haven't seen government jobs be cut by nearly as much as some had expected. That Challenger jobs report obviously wasn't too key. The increase in the unemployment rate, again, it's around about normal, so that's gone up to 4.1%. I think the market is willing to accept that 0.1%. And I think it's, this basically is just not really adding to a directional viewpoint. I think it's going to be considered slightly better than expected, but not enough, I don't think, to cause a recovery in the dollar. As you can see, dollar yen is a really big, important one. This is very typical post non-farm payrolls price action here. We're whipsawing about a little bit, but we are still in a fairly tight range of about 25 to 30 points. So 148, the level that we had got to earlier today, the level that we came down from, that is acting as quite a stiff resistance level in the very, very short term. But I'm going to go back to the S&P 500 E-mini futures. Again, they haven't really moved too much. Let's take a look at stocks as well. They're all quite lower in the US, in Europe. So that's worth looking at. I'm going to take just another look at that euro, at that dollar index. So yeah, so the dollar index suggesting that the move in what we've seen, the move that we've seen in the dollar on the downside, it might be done for now. I'm not expecting a big recovery, but it might just kind of settle around this 103, 80 to 70 level. And just to put this move into some context, it really, really is interesting what's happened to the dollar. There's been a massive turnaround. Policy uncertainty, higher bond yields in Europe. Let me just show you what it's done over the course of this week. This is the dollar index. Now, remember, the dollar index is basically the dollar against a broad basket of currencies. So the US's biggest trading partners. That's interesting this week that the dollar has fallen. If we look at a longer chart, so if I zoom out there, we're going to see that the dollar index is now back at its lowest level since early November. Well, what happened in early November? That was Trump got into office. So we haven't seen any decline since then. Momentum very much on the downside, as you can see on the right-hand side of this chart. It does seem like a relentless decline in the dollar. If we look at the weekly moves, I would like to show this to you because I think it's really worth it. We're going to look at that's the euro. Let me just put the dollar. Essentially, it just shows you every single currency in the G10 has strengthened against the dollar this week, even the Canadian dollar. But the euro has done really, really well. 3.7%. It's increased by 3.7% this week alone. The pound is up 1.8%. These are massive moves. They're moves like we haven't seen in the FX market for a very, very long time. I also just want to show you some volatility. Because volatility has been climbing without a doubt. 2025 is the year of volatility. Volatility had risen in the lead up to this meeting. Now that hasn't been updated actually, but I would imagine that it is going to come down at some point. And what we're going to look at now is I'm going to show you some bond market action. Let's see how treasuries are faring. As you can see, bonds are a sea of green. Now, when bond yields go down, that means bond prices have moved higher. So we're seeing a recovery in European bond markets. Now that's also feeding into the 10-year, these are 10-year yields, by the way, into the 10-year US Treasury yield, which is now accelerating its declines thereabouts, but not by much. So it had been down about 2.5 basis points ahead of this NFP report. It's now down at about 3, so kind of following Europe. I think the bond market is moving in a very global cycle at the moment. Whilst stocks have sold off really, really sharply in the US. And as we mentioned, as you can see, an absolute sea of red there. We've also got, if you look at the very right-hand side there, it shows you the percentage moves in the 5 days. The very last column shows the percentage moves on a currency adjusted basis. So Europe really getting a benefit from that stronger euro and that stronger pound versus the US dollar. But if you look at the column just one in from that on the left-hand side, then you can really see it's been a really bruising week for stock markets. It's been a bruising week for those of you who like risk, and I know a lot of you do. If we just go back to our volatility, we'll see that there in a moment. I just want to go back to just a quick look again at the dollar to see what the dollar is doing, and then I'm going to go on to some commodities because I know you guys love commodities as well. What we've seen is actually a bit of a recovery in the oil price. Brent crude back above 70. Remember, that has slipped below $70 a barrel. That is a huge move because $70 is such an important level. Now, Brent is up about 1.3%. So it's stayed relatively stable since then. Gold is slightly higher on the back of this report. Gold is number 15 in the metal side of things. It's now trading at $2,925. So it's up about $13. It had been up about $10. So if you remember, the gold price had actually declined last week. Well, it seems like all the policy uncertainty, all of the fact that political uncertainty had really overshadowed markets this week, there is still no strong conviction, but the gold price is rallying, and we would expect it to in this environment because of heightened risk aversion and also because of inflation fears. So tariff fears are causing inflation fears. These could be compounded on the back of this report, actually, largely because we have got some better than expected data. I'll just keep that commodity screen up there so you can see what's going on. But they could be a little bit, that could end up being just a little bit, gold is rallying because of the uncertainty. Commodities, we think, could actually react to the fact that the report was slightly stronger than expected. So maybe all of this uncertainty isn't impacting and tariffs aren't impacting the economy. We think that's far too early to say. And actually, we think Q2's data, so from April onwards, is going to be where you're going to see the main impact from tariffs and also government job cuts in the US. The other thing to point out, and it's really worth noting, we have got the Atlanta Fed GDP Now estimate of US GDP for the first quarter. Now that comes out later today. If you remember from last week, that was minus 1.5%. So it swung from 2.3% growth in Q1. All that economic weakness that we've seen made it fall to minus 1.5%. Now, if that recalibrates a bit higher, we may also see a bit less concern and a bit less risk aversion as we move into the end of the markets. Now, I'm just going to end on the dollar. The dollar is trading a bit lower now. Let's look at what the dollar yen is doing. Oh yeah, typical whipsaw on the back of this. I think the market is now realizing that this data point won't actually feed into what's going on in terms of tariffs in the US economy and also in terms of the changing geopolitical landscape and the risks to the US economy. We're going to have to wait for Q2 data. So this could be a long one. The market is pricing in a lot of bad news, but it certainly looks like the market is not willing to buy the dollar on the back of this report. I just want to look at stocks again. As you can see, yeah, still kind of a sea of green. We're not getting too much there. Yeah, we're not seeing any big impact from this NFP report. And I would say that's because, as I mentioned, we've got a long way to go before we before we get the data and we see the impact of these tariffs. We also have, of course, got a huge number of event risks coming up on the 18th and 19th of March. We've got another Fed meeting. But it seems to me, just to wrap everything up, we've got a slightly stronger than expected payrolls report, but really looking through that payrolls report, because it doesn't have the impact of tariffs or economic uncertainty in it. Secondly, the dollar certainly hasn't caught a bid on this. Treasury yields continue to fall. That could be eroding further support for the US dollar. The euro and the yen are maintaining pretty good strength on the back of that report, and we think that overall it's a bit of it was as expected. We also have the fact that the unemployment rate rose a touch, so we think the current trends will prevail, and actually that's not great. It's not really going to boost risk in any meaningful way as we get to the end of the week. I think the markets want to get to the end of the week, have a nice breather, and then make their decision, see what happens over the weekend, because it's a day-by-day event when Donald Trump is in the White House. Now, I'm going to leave it there. Thank you all for joining, and we hope to see you the next time we do a Market Live, and definitely next month for our March NFP report. Thanks so much.